Joining me now is David Rosenberg, founder of Rosenberg Research. David, it's great to have you here, and I'd actually like to start with your portfolio positioning recommendations to see how much difference there really is between somebody with your point of view on this and somebody who might be very concerned about inflation. What do you think investors should do?
Well, based on my view, I think that when the long bond gets 2 or above 2%, I think you want to be adding duration to your bond portfolio. I think that closed-end muni funds look good to me as well. And in the stock market, look, I think that we've had obviously a huge supply shock, and the demand earlier was sharply boosted by 2 massive rounds of fiscal stimulus in January and then in March, which really boosted demand, exacerbated the gap between supply and demand with the constraints. The constraints, by and large, are still here, Kelly, but what's happening is the demand side is starting to wane. In fact, I don't think many people even realize that real final sales in the third quarter was fractionally negative. So I think demand is going to play catch down now to what's happening on the supply side. Inflation is going to dissipate. I think that, these Fed futures contracts and the swaps curve that are pricing in 2 rate hikes next year, I would want to buy those. That will take the opposite side of the inflation and rates bet. And because I think the economy is going to disappoint, I'm not talking about a recession, but I think that growth is going to disappoint the consensus. You want to be in those sectors that are impervious to an economic slowdown, especially considering that not much, if anything, is going to happen on the fiscal side next year. So What does that mean? It means healthcare. It means staples. It means utilities being a bond proxy. And I'd say that my overall view, again, is against consensus. I think that a deficiency of growth is going to mean that growth stocks, given the scarcity, is going to be where you want to be. So I'm more in the growth over value camp, because value really needs accelerating growth and accelerating inflation. Yeah. And I don't think next year you're going to be getting either one of those.
Yeah, I want to joke that you should have, linked up with Cathie Wood and launched some ETFs with her a couple years ago, because when she talks about deflation, when you talk about it, I hear very, very similar points of view and kind of similar portfolio recommendations as well. But I'm glad you explained that, and thank you, because I think, I want people to understand you might see the economy very similar to the inflationistas do. Both of you are describing demand outstripping supply. You just think that demand will slow and others don't, and you mentioned real final sales, but nominal GDP is so strong. These 8% numbers, we didn't used to see anything like that during the past cycle. So what's your response when people say, yeah, but there's still trillions, in kind of dry powder that can be spent here? There's really strong nominal GDP growth, and we just didn't experience that in the past.
Well, look, for a quarter or two, you can argue that we had strong nominal growth. Last quarter, real GDP growth came in well below expectations. Kelly, it was just a couple of months ago that the consensus for the third quarter real GDP was 7%, came into 2%. You put on the inflation, you get nominal GDP doing what it's been doing. But as I said before, firstly, nobody can really define what transitory to me just means. This is not a permanent feature of the landscape, and nobody really knows how long the global supply chains are going to thaw out. But the one thing that I do know is you cannot forecast inflation with one curve. You can't just bellyache about supply constraints and not focus on demand. And what exacerbated the inflation of the past several months was the fact that we not only had the supply constraints, we reopened the economy earlier than expected, and at the same time we had 2 massive fiscal boosts, which are now in the rearview mirror. Now, people talk about $2 trillion of, quotes, excess savings, but excess relative to what? And I'm frankly surprised that economists would talk about excess savings, because when you go to economics school, excess savings is really where are savings benchmarked against desired levels. Does anybody know what the desired levels are? You can't say, well, we're $2 trillion of incremental cash balances, and we don't know. You can call it dry powder, but do we know if that will ever really go into the economy? For all we know, it's going to go into the markets. And so, the New York Fed has done the painstaking work time after time on the impact of cash transfers to the household sector on spending. And Kelly, only 30% of the money from cash transfers from the government goes into the real economy, and that's already happened.
Shepard Smith here. Thanks for watching CNBC on YouTube.